Thank you for joining us for our monthly webinar series from Local Market Monitor. And we take a closer look at this month's National Economic Outlook, which was written by Local Market Monitor's president, INCOHE Windsor. For those of you that don't know INCOHE, he's been analyzing real estate markets for over 30 years and is a graduate of MIT and Boston University. He's not your typical economist and has a knack for taking complex data, extracting what is important, and providing unique insights and tangible guidance on real estate markets. So with that, I bring you INCOHE and his insights on the economy.
Thanks very much, Carolyn. Every month, we look at the latest economic data to see what they can tell us about the current state of real estate markets and where they might be headed. Our underlying premise is that you make better decisions when you have a better idea of economic forces that affect supply and demand. We mainly look at job data because more jobs mean more demand for housing. But this month, we'll focus on home prices, which have surged in almost every market in the country, despite some of the worst job data we've ever seen. Here's what we're looking at. Here you see for the US as a whole, the increase in home prices every quarter compared to the same quarter of the previous year. This is not the total rise in prices, just the rate at which prices are increasing. But there's a good reason for looking at prices this way, because in a boom, the shape of this curve almost always looks the same, which means that we can use it to forecast what will happen next. After flowing along at a 5 or 6% annual rate for years, the average home price started rising faster in late 2020 and has been accelerating ever since, 18% in the fourth quarter of 2021, and that's just the average. In places like Austin and Boise, prices were up 30%. This surge completely blindsided me. I thought that during a pandemic and recession, no one would want to move and that prices would be flat. In at least the last 50 years and through 7 recessions, we've never seen this happen. Not only did prices jump, but they did so in every market in the US. Usually during a boom, just a handful of markets are involved. So this is a unique pandemic phenomenon, which means that we don't really know what comes next. I believe this boom in prices started because some people really wanted to buy a house during the pandemic, but almost nobody wanted to sell. It's easy for buyers to bid up the price on those few homes available, and once prices start to rise, other buyers and sellers are attracted, and a boom takes on a life of its own. No matter exactly how it got started, this boom now looks very similar to booms in the past. So we may be able to get some guidance from what's happened before. For example, here's what happened in Phoenix during the boom years before the 2008 recession. That boom started more slowly, but the shape of the price curve is very similar to what we're seeing now. The sharpest acceleration of prices occurred in early 2006, and prices kept rising until early 2007. What we're worried about with booms, of course, is what happened in Phoenix next, years of falling prices. I don't think this will happen this time. We didn't build an extra 5 million homes and sell them with subprime mortgages to people who couldn't afford them. Nonetheless, prices have now risen so much in some markets that a bust is almost certain. And if the war, if the war in Ukraine drags the world back into recession, all bets are off. Getting back to the current situation, there's evidence that we've already seen the bulk of the surge in prices. Use the national picture again, only this time with monthly data through December. You can see that price increases seem to have hit a peak. Here's that same situation in the Southeast states. It's not so clear-cut. Again, these are monthly data. But it's clear on the West Coast, in the Middle Atlantic states, and in New England. And here's the takeaway. If the peak of the increases is right now, then we'll probably see another year of increases, but at lower and lower rates until prices finally stop rising. That's what happened in Phoenix and dozens of other markets before 2008 and in other booms at other times. Then the question becomes, what will happen with home prices once they max out? Will they stay high or will they come down again? And if so, how much? Here's the Phoenix data again. Assuming there's no recession in the near future, what are the prospects? That depends on the level of home prices that local markets can support. And that level is closely tied to how much people can afford to pay. We estimate this level in local markets by calculating a so-called income price that rises along with the local average income. Here's what that looks like. Las Vegas is sort of a poster child for boom and bust cycles over the last 20 years. The blue bars show the actual home price. The red dots are the calculated income price. You see that the last time prices shot well above the income price, they eventually crashed, then took years to recover. Over the last 50 years, whenever home prices in any local market have been much higher than the income price, they have always, let me repeat that, always come back down again to the income price, and sometimes even more. And that's why I'm a bit worried right now, because home prices already are a lot higher in a lot of markets, and there are more increases to come. In a small low growth market like Topeka, Kansas, they're only 12% higher. But in high growth Salt Lake City, for example, they're already 40% higher. I think a market is seriously overpriced when the gap is more than 20%. Despite the strong growth in the Salt Lake City economy, it's difficult for me to avoid the conclusion that home prices there will come down again. Maybe not a complete crash, but a meaningful correction. And then home prices could stagnate for years until income catches up. What does this mean for investors? Well, for one thing, if you own a property in a market where prices have shot up and have thought of selling, you should do that during the next year. For another, if you think of buying a rental property at today's higher prices and just jacking up the rents the same amount, forget it. You might be lucky and find tenants who will pay more, but investors shouldn't count on luck. Don't home prices always result in higher rents? After all, prices are higher because there's more demand for housing. The short answer is no. Here's a table of markets around the country, and I didn't cherry pick these, that shows how much average income, average rent, and average home prices rose from 2012 to 2019, before the current surge in prices. Income and rents increased almost in lockstep and were unrelated to home prices. Now, if you go back to the last boom period, before 2008, for these same markets, you'll see that higher prices did pull rents up faster than income, but only in the most extreme cases, shown here in red, where prices more than doubled and not nearly enough to make up the difference. Now let's look at the price and rent history for our two markets. Here's the annual increase in average rents and average home prices in Salt Lake City, along with the size of the recent price surge. Even in normal times, home prices have usually risen more than rents. Here's the same data for Topeka. In smaller markets, the data are more volatile, but in low growth markets like this, rents often can be a better bet than home prices. So if rents won't rise enough to match higher home prices, how can you invest in rental property at a time like this? One way is to forget about single family properties and instead invest in apartments. Their price lies in the rental income and won't rise as much. Another is to split single family properties into rental units, and another is to buy low-end properties and upgrade them to higher rent values. To follow any of these strategies, it's essential that investors be aware of the local rent range. Rent ranges are a very useful tool for investors. You can find them from surveys the Census Bureau conducts in all communities across the country. The census asks renters how much they pay, so for every zip code area, we know how many renters pay how much monthly rent. A zip code area happens to be a useful size. They typically have a population of 30,000 or so, basically a small town. So people who live there tend to stay there. This means that the renters for your property probably will come from that profile. We analyze the census data to find the range of rents with the highest concentration of renters. We call this the best rent range, because if your rents are in that range, you'll have the least trouble finding renters, either now or in a year or two, when the average renter moves out and you have to find a new one. Typically 50 to 70% of local renters fall in the best rent range, and it's especially accurate at the upper end, above which the number of renters falls off very sharply. At a time of rising home prices, when sellers of properties will be assuring you that you'll have no trouble finding tenants who will pay higher rents, or if you plan to upgrade a property to higher rents, be sure to compare those rents with the best rent range. You don't have to rent in the best rent range, but if you need to go well above it, you're taking a big risk. In Salt Lake City, for example, as we see here, in zip code 84105, a rent of $2,000 a month is fairly common. You'll find lots of takers. But for a property in zip 84103, you'd be pricing yourself out of the market. That's it. In this time of uncertainty, let me plug our investors metro analysis, which shows how best to invest in this environment, how much risk you face in a local market, and the best rent range in each local zip code. Available for 200 markets, it's as easy to use as 1, 2, 3. Thanks very much for following along. This is our National Economic Outlook. I'm Ingo Windsor.